watching Bloomberg Quint. In maintaining fiscal discipline, did Budget 2019 miss measures to boost growth? Or the other way to look at it is, did it avert the crowding out of private credit and investment? And in order to maintain this fiscal discipline, has the government wielded the tax stick too hard? Aggressive overall tax revenue targets, a surge in surcharges, higher cess, a cash withdrawal tax, a buyback tax. Those are the ones we could find so far. And while it has now extended the lower 25% tax rate to corporates with an annual turnover of up to 400 crore rupees, let me tell you that the budget documents show that the effective tax rate for all tax-paying companies in FY18, that's the latest data that was available, was 29.5%. That's correct. The effective tax rate for corporate India, 29.5%. Now, what impact does all of this have on private investment and private consumption, both of which are areas that have seen a slowdown in the last several months? To talk about all of these issues, I am joined by Vivek Karve of Marico, Shankar Raman of L&T, and Ashok Wadhwa of Ambit. And we hope to be joined very quickly by Seshagri Rao of JSW Steel as well. Gentlemen, to all of you, a very warm welcome on this budget day. I'm going to start by asking you if this budget did enough in terms of the growth impetus. And before I ask you for your answer, I'm going to lay out some of the things that maybe might apply to this question. For instance, 1.95 crore rural homes over the next 2 years, 1.25 lakh kilometers of rural roads over the next 5 years is what the finance minister announced. Also announced public-private partnerships to build out railway infrastructure, but no specifics there. Structural and tariff reforms in power, but we don't have all the details. A blueprint expected soon on gas grids, water grids, national highways and regional airports. And finally, the other thing that might help boost the real estate business and housing infrastructure is the additional deduction on interest on loans for affordable houses. Now, do all of these things together, Mr. Shankar Raman, provide enough of a growth impetus?
See, in terms of application or the areas to focus on, I don't think I have much complaints, because I think India is an infrastructure deficit country, and I think they're focusing on all the right areas that require attention. The biggest worry, though, is where they're going to find the money from. I think the canon of taxation to some extent will provide answers, but that just is insufficient. And I thought the question was left a little hanging and unaddressed when they said a committee will look at the structure, form, flow of how the institutional credit will flow into infrastructure sector. There were repeated references to PPP. The amount of disputes that is on the table insofar as the current PPP go, unless they are resolved in some satisfactory manner and government comes forward with some entrepreneurial manner of resolving these in an expeditious manner, PPP is going to remain in the wish list. For PPP to materialize, or for that matter private capex to materialize, I think the message on consumption and the usage should get stronger. And I find that both from a means to achieve the investment goals as well as the stimulus to consumption lacking in this budget document.
Okay, so you're saying that they've said all the right things, but they haven't done enough to prove that the implementation of these intentions might actually occur not just this year, but over the next 2-3 years. Have I summarized that correctly, Mr. Shankar Raman?
I think so. You're right.
Okay, Vivek Karve, I mean, look at it from the point of view of there has been since February an additional outlay in the agriculture space as well, thanks to the Kisan scheme, which recently they expanded further. They said they wanted to expand the pension scheme as well. Let me ask you this question. Do you think that this push towards rural infrastructure, whether it's rural roads or it's rural homes or it's affordable housing, any of this is going to help build a degree of demand in the economy?
Yeah, I would say so. I was actually looking at some of the numbers. So if you look at the expenditure budget which the government has put out, agriculture plus rural, about 7.3% of the total outlay was in 18-19, but if you look at 19-20, it has jumped to 8.8%. And if you look at the social infrastructure, in which I will include things like housing, women, education, and health, that number for 17-18 rather was 7.7%, and which is seen jumping to 8.6%. So which means that the government is very committed to spending the budget expenditure on a broad-based growth, which is more for the masses and not necessarily for the classes. And if this materializes, then which means that more disposable incomes in the hands of the belly of the market, which is the consuming class, which is middle class. So I would say that if properly implemented, it will give some rise or provide impetus to the demand for the FMCG or consumer goods in the industry.
Mr. Wadhwa, do you agree with this? I'm going to bring back the issue that I raised right up front, which is to fund any of this, they need money. And right now, the tax revenue numbers that they've put in the budget seem very ambitious or aggressive, one might say. They hugely underperformed the FY19 targets. And it looks like they're setting themselves up for more underperformance this time as well. I mean, if you look at the provisional actuals on a gross tax revenue basis, they grew about 8.4%. And they've estimated an 18% increase in gross tax revenues for FY20. If they don't make this money, then all of these pronouncements in the budget are just that, right? Pronouncements.
You're right, Menika. I think if you look at the fiscal numbers put out by the finance minister, 3.3%, you can see that that's been built on the back of a very aggressive tax collection. If you then make a comparison between tax collections in the first quarter of this current fiscal year with last year, you see that there has been zero growth in tax collections. From zero growth to expect between 15 and 20% corporate and GST tax growth is truly very aggressive numbers. But you know, even if the government doesn't achieve that and moves the fiscal deficit a little higher, I wouldn't be terribly worried about that at this point of time. I think at this point of time, the priority for the government, as you rightly pointed out, was how do we get the economy kick-started? And again, there are two parts to it. You touched upon the consumption part. I think over many years, the general consensus has been continue providing stimulus to the consumption engine so that you know everything that we produce gets consumed, and that's been the engine that's really been firing the Indian economy over the last many years. We know that on the investment side, which is what this government really needs. I mean, don't forget that if you are not doing private investment, and if you're not creating manufacturing, and if you're not generating more exports, the biggest target of getting greater employability is a serious challenge. So I think this time around, the focus seems to be on the investment, and I think the finance minister pretty much articulated it. Thus far, investment has been driven by pure government expenditure. But given the constraints that the government has of a sluggish economy, of a relatively weak tax collection mechanism at this point of time, the government needs to realize and has understood and has acknowledged that we need to bring in mechanisms and incentivize private investment. One of the key features of this budget is the recognition and the implementation of how foreign capital that is otherwise available in abundance today, and that is very, very attracted towards India, can be channelized further for substituting for paucity of capital in the domestic market. So whether it is opening up the insurance sector to greater investment, and we know that insurance sector alone can bring in billions of dollars. There are strategics who are very keen, there are financial sponsors who are very keen to invest more in the insurance sector. Aviation, don't know what the outcome would be. Media and entertainment, they have tried to increase the ownership. Insurance intermediation, they have gone to 100%. They have for the first time recognized, I think the finance minister made a specific mention of how 24,000 crores have been invested through private InvIT, and Shankar should be smiling on that because he's one of the big initiators and contributors of that capital being generated here. L&T has through their road private InvIT. And for the first time, they have also allowed FPIs to invest in bonds, listed bonds of private InvITs in India. That was a lacuna because remember, banks can't finance the debt in private InvITs. And therefore, really, private InvITs had to step out and go to the bond market. By permitting FPIs to invest in that bond issuance, they're creating greater and deeper possibility of raising debt. So I think there is recognition that there is lots of foreign capital hungry to come to India. We must facilitate that entry. We must make rules easier. And we must attract that capital so that the private investment cycle gets kick-started. And that's really been the bigger focus in this budget, I would say.
But do you think that the efforts made towards kick-starting private investment, Mr. Wadhwa, have been incremental, that they could have done so much more, but they didn't? Or the other way to look at it is, for instance, by saying that we will capitalize PSU banks by 70,000 crores, we'll throw a lifeline to NBFCs to help them in this, sort of beleaguered state that they are in. We'll consider, sovereign borrowings in foreign currency. These are all efforts to kickstart, A, the credit cycle within India itself by recapitalizing public sector banks, B, by moving some of your government borrowing offshore. You're maybe choosing not to crowd out private sort of capital raise here in India. Are these enough sort of steps to help push investment in any big fashion?
I would say they are very good starting points.
Okay.
They are obviously not enough. I mean, a lot more need to get done as time lapses, but there's certainly very, very good starting point. 70,000 crores in the banking sector, and even if you say that half of it is used to provide for NPAs, 35,000 crores of additional capital can result in a serious uptake of credit by the domestic banks. By borrowing in the global market and making more money available in India to Indian corporates, government is trying to encourage creation of a debt capital market. And I would say these are all very important first steps in the growth of that in that segment.
Okay, great. Now we have Mr. Seshagiri Rao who's joined us. Mr. Rao, we've been talking about whether this budget has done enough to really help push or boost growth from the point of view of both private investment and private consumption. And at the end of the day today, do you feel more encouraged that you might in fact see a pickup, let's say in the next few months, on account of some of the articulations of the finance minister, on account of some of the measures that we've just been discussing? Or do you think it's all still incremental and peripheral?
No, this is a good budget from that point of view. The major problem today is the liquidity or financing to either for consumption or investments. So those issues I think they try to address with a very clear headline number of $5 trillion economy by 2024-25. So whatever they have done in the case of NBFC and also deepening the bond markets and also allowing FIIs or FPIs to come into the market and permitting them to transfer their securities within the lock-in period to the domestic institutions. I think these are all the great steps which will definitely improve the liquidity and the lending in the market. So which should stimulate, in my view, both consumption and also the investments. Coupled with the government expenditure, which is including the extra budgetary support, is over 8 lakh crores of rupees. Coupled with again the state's expenditure, I think this engine should bring back some spur in the investments cycle and also consumption.
But Mr. Rao, didn't you think that this was a budget of many small, tiny parts? No one big sort of overarching vision that unified it? Or am I reading that wrongly?
I don't think so. The overarching already has given the macro headline number, that is a 5 trillion economy. So for doing that, what is required to be done, I think the vision is very clear. So whatever short-term problems which the economy is suffering today, is that it is not actually the demand is completely disappeared. The cause of slowing down in the demand or investments is because of banks are not able to lend, NBFC there are problems, and the foreign investors are not able to come into India. I think those issues are adequately addressed in my view, and at the same time not increasing the taxes, notwithstanding those 50,000 individuals who have to pay more taxes. Taxes more or less remained at the same level as it used to be.
4 of those 50,000 are on this panel, but I'll come to taxes in just a bit. Since we're talking about access to finance at this point in time, if I can bring you here in, Mr. Shankar Raman, do you think that there could have been more that could have been done on the NBFC front?
See, actually the problem with NBFCs are multifold. One is, I think the sector is under a lot of cloud, some of it proven, a lot of it out of fear of what markets may not know. The drying out of the liquidity and restricted access that they have, coupled with some of the NBFCs were part of larger groups, in fact have another problem of having to comply with the Basel norm about maximum group exposure, which has been brought down in the name of risk management and prudence significantly. It used to be 40% of Tier 1 and Tier 2 capital. It has become 25% of Tier 1 capital. So large groups who have the pedigree to support the financial services business are constrained because they have to allocate resources between various engines of growth that they oversee. In addition to that, you have the market fears about NBFC's asset quality being under question, and a lot of this has also got to do with the suspect asset valuation and the underlying quality of assets per se. For example, the real estate sectors has caused stress, the loans against shares portfolio, the construction financing. Some of these, the sectors are under stress. So consequently, I think it was a bit too much to expect the budget to address all of these sectorial business related problem. But what it gives a window, it actually opens up a window by addressing and recognizing that liquidity is indeed a constraint and something needs to be done, and by allowing FPI, FI inflows to participate into the instruments of NBFCs, the core investment company and deposit taking NBFC is a good step forward. But I don't think this is sufficient to solve all the problem, just a crack that has been opened up. And a lot needs to be done between the regulator and the regulated to A, understand the problem in common, and B, try to solve it. So a lot of work needs to be done, Menaka, outside of the budget, but the budget does recognize this problem.
Okay, maybe that recognition is enough. I want to move to the issue of tax troubles, but before we do that, Ashok, Wadhwa, can I ask you a little bit about what you made of this divestment set of announcements that came in the budget today? Because in the run-up to the budget, a ton of people that we were speaking to here on Bloomberg Quint were speaking about how asset sales should be the big focus of being able to raise resources for this government and then use those resources to stimulate the economy as opposed to widening the fiscal deficit. Now, they've maintained discipline, no doubt, but the articulation on the asset sales side has been, depending on how you look at it, rather mixed, right? They said that they've upped the target to a little over 1 lakh crore rupees, which is nice because the FEP target was 90,000 crores. And then they've said some small things that were interesting, but I'm not sure how easily they'll be implemented. For instance, the use of PSU land for infrastructure projects, either singularly or in joint management with project companies. They also spoke about rethinking or relooking at the ownership norm of 51%. So they said we will include PSU and LIC ownership within this 51%, and that might in fact allow them to reduce the government's direct stake in many of these companies. They've spoken of the ETF that they want to do additionally. Is all of this in a sense suggesting to you that maybe they're not articulating it very clearly, but there's a big asset sale opportunity available over the next year or two, and this time they're going to be serious about it?
So there are two parts to the question, Manika. One is from the government perspective, and second, I thought you asked me about the reduction of 65 to 55%. Is that the second question?
No, that's not. The second question was, I think,
capital markets,
no. So I'll get to the capital markets in a bit. But what they did say about, the government ownership in PSUs, they said that when we look at where we need to maintain 51%, we'll include other public sector unit ownership and LIC ownership to make up that 51%. So effectively, that might allow them to reduce or disinvest some of their ownership.
Yeah. So I think as you rightly pointed out, moving the target from 90,000 to 105,000 is a good idea. I think in an era where tax collections are struggling, government needs to find newer mechanisms to augment their revenue collection. And I think divestment is a perfectly good idea. We've been encouraging the government to do more of it. It is this government in its different avatar that really began the divestment process. Remember, Prime Minister Vajpayee's government began the big divestment process when they were in power in early 2000. So I think that's a good idea. I personally believe that the government is both inclined and committed towards doing more and releasing more of government capital that is currently invested in PSU undertakings. The new idea, which I think is a creative idea, of including government-owned enterprise ownership as a part of government ownership, is a very nice way of government now saying, of course currently it applies only to non-financial services sector, so it doesn't apply to banks. But it could just be the first right step. If this is successful, there is no reason why 2 years from today, the much demanded issue of why can't government create more headrooms in the banks so that banks can go out and raise more capital from the market be implemented. So I think allowing GIC, LIC ownership to become a part of government ownership, therefore allowing government to go below 51, releasing more capital, is certainly a very positive step, particularly where companies can be listed or are listed and more capital can be raised in those good companies. As I said, it could very easily, if this is successful and government can show over the next 12-24 months that through this mechanism government has been able to, through capital markets and other strategic initiatives, raise a lot more capital, there is no reason why there will not be an adequate example that the government should do the same thing for public sector banks 2 years from today. The only thing I would say is, if the government ownership is below 51 and LIC stroke GIC make up the balance, will the company be treated as a government undertaking and be subject to all the rigors of a government undertaking, governance, employees, CVCs, or will the government allow such companies to be called government owned but not necessarily a government undertaking, in which case the governance standards and ability to bring in outside professionals, I think, will get significantly enhanced. So one of the requests that we have had, or requirements that we have had, that government relook at governance structures of public sector enterprises, will get automatically addressed through this week.
Okay, fair enough. Though I felt a bit that, maybe there could have been a larger or more ambitious articulation on asset sales because we missed that opportunity dramatically in the last 5 years, right? I mean, every time we set a disinvestment target, it was only in the last 3 months of the fiscal that we were able to meet that. And, it hasn't been as big a part of revenue raising or resource raising for the government as it could have been. So I wish that they had done more. But I'll come to tax because I think there's a bunch of commentary there that's waiting to... Sorry, you wanted to add to that?
No, I just said let us hope that this time they have underestimated their vision and that they are going to actually implement more than what they have stated, in which case we will all be very happy, because we do know that the tax collections are a bit aggressive in their projections.
Yeah, okay, they're hopeful. I mean, divestment is not something to be easily public about because of all the various opposing voices in this country. So maybe they're just playing it quiet, but will actually, sort of exceed our expectations on that front. Let's come to tax. The 25% tax rate has now been extended to a slightly larger group of companies, up to annual turnover of 400 crores and more. But that really doesn't cover the big chunk of actual large tax-paying companies in this country. So that's bound to be a bugbear across corporate India. We now have an effective tax rate that corporate India is paying of close to 30%, so 29.5% almost. Then they introduced a buyback tax this time. We've seen a slew of custom duty changes, a cash withdrawal tax that is bound to impact small businesses, a higher cess on petrol and diesel, that will impact everybody across the consumption line. And then, of course, the surcharge on the super rich, which now has effectively created a 40% tax bracket, which we didn't have so far. What do you make of all these changes, Mr. Seshagiri Rao, when it comes to tax? Have they wielded the tax stick a bit too hard this time?
What the corporate India is expecting a reduction in the tax rates, because the 34-35%, even the effective tax rate you talked about below 30%, But many of the companies who are paying normal tax rate, it is 35%, which is in fact is on higher side. Even MAT paying companies, the tax rate is 21-22%. So therefore, the expectation from the corporate India, particularly the companies which are in that 0.7%, which she talked about, are paying a huge amount of tax. They are the companies which also make large investments. So if the tax rate remains same and if it is not as per the international levels, I think the reinvestment out of the cash accruals will be a limitation. So I was expecting really some reduction in the corporate tax rate and the MAT rate and dividend distribution tax, and also some incentive for investments, fresh investments. I think they are the things which really could have helped to some extent to bringing back the private sector investments in addition to the other steps the government has taken.
Yeah, you know, it's a tough one to argue one way or the other, Vivek Karve. They need the revenue if they want to maintain a basic level of government expenditure. But equally, if they allowed for a lower tax rate for companies, they might help boost investment on that front. Or do you still think that we're a little far away from the investment pickup happening? And so, a lower tax rate would have only meant gains to shareholders, not necessarily gains from a private investment point of view?
I would say India needs a significant amount of investment to be made both in the physical infrastructure as well as in the social infrastructure. And let us also not forget the fact that we are a developing economy with a significant proportion of population in middle income bracket. So there has to be someone who funds this growth. And government is looking at those top companies, profit-making companies to fund this growth. Probably that's also the reason that the super rich are being taxed a little more. In my view, this is a short-term pain for a long-term gain, because if we have to be a 5 trillion economy, some part of the economy has to bear the load. It's a tough decision for the government. It's not an easy solve. But what they're trying to do is 99% of the corporate India, which is below 400 crore, they're trying to make their life a little more easier. In fact, there are a slew of announcements today making the life of the startup India also a little easy, which will then fuel growth and fuel innovation in the country.
So you're okay with the fact that they did not cut tax rates for all companies to 25%. I'll take this question to Shankar Raman then. Mr. Shankar Raman, you know what bothered me, and I wasn't really...
I'm sorry, I...
Go ahead, Vivek.
Yeah, I'm saying I didn't mean that. What I'm only saying, it's always not possible for the government to please everyone.
Okay, you're being accommodating. Mr. Shankar Raman, what bothered me really isn't that the fact that they didn't cut corporate tax rate to 25%. Everybody knew that, you know, the tightrope walk was too tight for them to do that. But what's really bothered me is this continuing use of surcharge and cess in order to be able to raise additional tax revenue. Not the best way to do it at all, I would say, principally. What's your take on all the, you know, the sum total of the tax proposals in this budget?
See, while I do subscribe to the traffic, what the traffic can bear principle, but I'm a little disappointed that we are not doing enough to broad base the tax coverage. You see, I think to a point we can keep charging more from the known customers, the profit-prone, growth-prone companies, and now to add it to that is high net worth individuals. But how much more will you be able to extract out of them? Will you take another 5%, another 7%, 10%? If you want to view this as an interim step, it's very important that we also not lose sight of the broad basing that is required. I find if I look at the numbers that have been put out between 19 expected estimates and 20 budgeted estimate, the growth in GST is almost flat. We are talking about possibly net of sharing to the state, the central collection for about 6 lakh crore, which is very close to the level it was, and you gross up for the state share, it comes to that lack of 1 lakh crore per month kind of collection that is happening today. I do believe that if you're going to have the making of a 3 trillion economy, I mean, let's set aside the 5 trillion economy as an aspiration. If you talk about a 3 trillion economy which was promised by end of this year, I do believe that the trade and commerce that underlies this 3 trillion economy has much more potential to participate in this growth. To some extent, I think we are also directing the equity holders to move towards subscale companies, because if it's going to be profitable for the company to, from its own PE, to be a shareholder in a 400 crore or sub 400 crore company as compared to a $4 billion company, I don't think we are addressing the right levers. I can stay with this if it's going to be a very temporary transitionary phase, but I'm somehow not getting the confidence that we are addressing the larger issue, which is broader coverage of tax. Additional cess has been a pain, and I think we've not seen enough instances of this cess getting rolled back. I recall Bangladesh war cess, we continued to pay for long years. And secondly, I think increasingly the budget speeches are getting to be political speak. The details are missing. If not everybody can pore over the pages of fine prints to make out where the money is coming from and where the money is being spent. I somehow feel that more articulation is required as to how these cesses are being spent. We've been subscribing to these cesses for road upgradation for many years now, but we see the state of roads continue to be poor. So I think there is a combination of good governance, accountability, very sharp focus on means and end use that is required in the government documentation and the articulation. If we'll have to draw conviction that we indeed are contributing to a cause that helps the country grow stronger. Economically speaking, I think it is going to be return dilutive to have this larger tax outgo. And so the choices for the investors are going to be multiple as to how far they're going to be in terms of valuation supportive of large profitable companies.
Yeah, no,
but according to me, I feel a little disappointed.
No,
I feel a little disappointed at this concentrated dose of increased taxation.
I agree with you, and some excellent points there. In fact, I should have pointed out right at the beginning, we had a 2-hour speech, and the finance minister really gave us none of the key numbers in that 2-hour speech. And I think, in fact, even the fiscal deficit number, it was almost like an additional thought at the end, where she said, oh, by the way, it's 3.3 that we're projecting for FY20. It was rather unfortunate that we did not get any of the big headline numbers in the speech, but there was time, in fact, to mention that there will be a TV show for startups. Ashok, Wadhwa, tax is your wheelhouse. There are very different ways of looking at this. I've already articulated much of this through the conversation. Very aggressive overall tax revenues, the use of cess and surcharge, the cash withdrawal tax, which is going to be a bit of a pain point for small businesses, that are still recovering from both demonetization and GST. What do you make of this entire bunch of tax proposals?
So let's look at the 3 different tax proposals or 4 different tax proposals broadly that have been introduced. First, limiting the 25% tax to companies with a revenue of 400 crores. I personally don't think that the government had any elbow room to try and increase it. It covers 99.3% of the companies. It doesn't cover 0.7% of the companies. The large companies, I don't think, expected it given where the economy is and where the tax collections are. So I think it was par for the course.
Okay.
The buyback tax of 20%, listen, it was coming for a while. There was an arbitrage between dividend distribution and buyback. That arbitrage got reduced last year when capital gains tax was introduced, and buyback on market was subject to 10%, but it still kept the 10% arbitrage. I think that was a little inadvertent. Those who benefited from it over the last 2 years, we saw a spurt in buybacks. All need to reconcile to the fact that they got an inadvertent benefit, that the arbitrage has now been blocked, and therefore 20% buyback is, it was coming. It was a question of when it will come, because everybody knew that people were using buyback as a mechanism to reduce the cost of distributing dividend. Let's go to the third tax, which is the surcharge on the rich, super rich. You know, we are all aggrieved by it. Of course, we are all aggrieved by it. I think Shankar pointed out, and Seshagiri Rao pointed out before that, you know, how much do you milk the one cow that's been healthy and that's been providing you with decent output? I hope the super rich don't become another example like the tobacco company and the liquor company became at the state level over many years during the excise duty regime, where inevitably every year the missing link or the delta was plugged by increasing duty on tobacco and on alcohol. So I do believe, hopefully more in lighter vein though, that the super rich don't become, you know, kind of example like those two products for direct taxes. I mean, the government had to collect taxes somehow, find new ways to augment their current shortages, and I guess once more they have leaned on the super rich. The last point really on taxes, which one was hoping one would get it, but we didn't get it, was that in its drive and desire to encourage long-term investment, government was going to increase the capital gains tax back to 3 years and say stocks held beyond 3 years will be tax exempt. I was hoping that would come, because that was very consistent with how the government's been thinking. I want to encourage long-term investment in the market and avoid the speculative nature which causes volatility. But that unfortunately went missing this time. Hopefully next time when government has more elbow room, that can perhaps be a new desirable incentive that the government can provide. While all this happened, we can smile and say, we had all heard about inheritance tax, we'd all heard about wealth tax, we'd all heard about gift tax. Thank goodness that the government only imposed this 20% extra surcharge and didn't bring in new taxes, which would have created its own complications. So we can all smile a little on that.
You know, Mr. Wadhwa, if you remember Arun Jaitley's budget speech from 2015, when he was abolishing wealth tax, he had given a very clear rationale for it, saying just to collect 1,000 crores, which was the revenue from the previous year in wealth tax, the cost of collecting that tax for wealth tax was much higher. So he said it's much easier for me to just increase the surcharge, which applies to Crorepati. If you remember, the Crorepati tax was introduced by Finance Minister Mr. P. Chidambaram. And then he said, I'll just enhance the surcharge rate and I'm abolishing wealth tax because it's just much more efficient for me to collect through surcharge than to collect through wealth tax. So I wasn't sure that inheritance tax or wealth tax was going to make a comeback. In fact, for me, it was going to be surcharge, except that they have done such a substantial jump in surcharge, right? And this is the optics game that governments play, not just this one, but the previous one. You don't raise the actual tax rate, but you just keep taxing people more, whether it's through a surcharge or through a road cess. And that just seems, you know, not the right way to do it. But we've discussed surcharge and cess to death. I want to bring in one last point before we totally run out of time. This proposal that... yeah, go ahead. Go ahead.
Just one more point probably which is getting missed today is, if you look at the increase in the customs duty revenue as well as the excise duty revenue,
yes,
and also the external borrowing that the government is planning to get to finance some of the expenditure, the inflation impact of these three increases is something which I believe is getting ignored. But probably it may have a cascading impact on the inflation unless the government has a very, very different outlook on the overall inflationary scenario in the country.
I must confess, Vivek, I have not had a chance to go through all the custom changes. Could you elaborate for us, if you've managed to study it, why and how you think this could have an inflationary impact? Which specific products or items are you referring to where customs duty has been increased that you think might end up having this negative impact?
No, I'm not referring to anything which is specific. However, if you look at the overall receipt budget of the government, there is a 23% increase in the customs receipt and there is a 15% increase in the excise duty. In addition to that, about 7 lakh crore external borrowing by the government is being proposed. So all these three increases, I believe, can have a cascading impact on the cost of production in the country.
Okay,
which would then mean that the prices can go up.
Okay, fair point. And I think that's one aspect that even I needed to look at in more detail. So we'll leave that to a future conversation. I'll come back to the proposal that Nirmala Sitharaman made, Ashok Wadhwa, to say that I'm going to ask SEBI to increase the minimum public shareholding threshold from 25% to 35%. Now, I don't imagine this is going to happen in 1 year or 2 years. First, the regulator needs to move on this. Then I'm sure they will give enough time to companies and promoters to be able to do this. But do you think that this is a broad positive, that it brings more public investors into these companies, or a negative because what it could do to stock prices or promoter holdings?
So, we did a quick back of the envelope calculation, Manika. Companies that currently have 75% ownership, promoter ownership, whether the promoter is an Indian promoter or a foreign company, the current market cap of these companies is approximately 40 lakh crores. So 10% will effectively mean about 4 lakh crores of additional paper coming to the market. The first question is, does the market have the ability to absorb it? And the answer to that is, I'm sure the regulator is going to be very, very sensible. SEBI has always been very sensitive to not overloading the market. And therefore, if it's built on an adequate time frame, I think given the current interest, particularly by FPIs in the domestic market, I think there is enough appetite to be able to absorb that new paper that is likely to come to the market. Second question is, how do multinationals feel about it? Multinationals anyway don't like listed companies. They were holding on to 75%. Now they have to decide and dilute themselves to 65%. I would say at one level they won't like it, but at the other level, there is a element of speculation that's built in every single multinational stock on whether the company will remain listed or remain unlisted. Now there will be a decisive action. If the company wants to remain listed, it will bring its ownership down to 65%. If the company wants to use this as an opportunity to delist itself, because otherwise it's only going to become more expensive, then this is the time to do it. And with the new delisting rules being fully incorporated, I would say this is as good a time. I'm not saying it's necessarily cheap, but this is as good a time to exercise that decision and remove the speculation from the marketplace. I'm sure Indian promoters, etc., some may not be concerned about it, some may be unhappy about this dilution. But what it does do is improves India's position because of liquidity on the MSCI index, as we heard today. We do know that there are some very, very good companies, and if more paper from those companies comes into the market, there is enough capital. Currently the money goes there and it's inflating the prices, but once there is greater supply, I think the prices and the prices will stabilize, because the demand and supply will find a fairer position to stabilize that. So I would say, still don't know why government did it, why government wants to do 75 to 65. Can't guess why government wanted to do it as a part of the budget, because normally SEBI regulations are introduced as a part of discussion at the SEBI board meeting. But there are merits and demerits like in everything else.
Yeah, fair enough. The first time when they did the 25% thing, I can't remember if it was first mentioned by the government in a budget or in some other forum, but it came from the government, and it was then SEBI and Mr. UK Sinha, who was then the head of SEBI, who spearheaded that and created a regulation around it and gave companies 3 years. Mr. Shankar Raman, as if you didn't have enough pain points today, I'm going to add one more. I believe that L&T shareholding in L&T Technology Services and L&T Infotech is 75% and above. So in fact, if this minimum public shareholding norm does expand or increase, then it will be incumbent on you all to reduce your stake.
Well, if regulations demand that, I think we have to comply. But as Ashok was mentioning, I think we'll have to look at it as an opportunity to make the stock more popular and more available to the market. And hopefully the value creation will help compensate the dilution, even if it is regulation-led. So I suppose we are not looking at it as a very significant negative. We do have listed companies where we hold less than 75%. So that's fine by us. But I do expect that SEBI would give its time frame so that there is not an abrupt release of supply of these stocks into the market.
Yeah, undoubtedly. I'm sure they will. All right, I'm going to give the last word then to Seshagiri Rao because, I think we've had 2 budgets this year, 1 election. The news events are out of the way finally. We go into an earnings season in a few days from now, Mr. Rao, and then we've got the second half of the year, and it's not looking very pleasant at this point in time. What do you make of the next 6 months' demand, investment, and economic growth?
Yeah, there is a clearly slowdown which is visible, as I mentioned to you in the beginning, that this slowdown is not because there is clearly demand is not there. Demand is there, but financing is the issue. I think this financing issue is partially addressed through this NBFC and deepening of bonds and FPI and all these things. So I think generally in India, this July-September quarter is a sluggish quarter because of the monsoon. Economic activity will be lower. So I don't think anything dramatic will happen in the next quarter. But if I look at the entire financial year, the second half appears to be better.
Vivek, would you agree with that? Because adding to the woes around private investment, we've seen the last 6 months, plague us with a slowdown in private consumption as well. Are you more hopeful about the second half than the first half?
Yeah, there is always hope.
Okay. I think that's the shortest and nicest way to end this conversation. Gentlemen, thank you very much for joining us today. Ashok Wadhwa, Shankar, Raman, Vivek Karve, and Seshagiri Rao. And thank you very much for watching Bloomberg Quint. That wraps up the business view of Budget 2019.